Todd Dunn here. This is the second video in my retirement income planning series. This video is about annuities. What I'm going to do in this video is tell you what annuities are, say a bit about how they work, and then discuss the pros and cons of annuities. What is an annuity? Basically, an annuity is a contract between you and an insurance company in which you make a payment to the insurance company, and as a result of that, the company agrees to make periodic payments to you for some period of time or for your life. If you choose a life annuity, you're setting up an income stream that will last for your entire life to guarantee that you will not run out of money, which is one of the main attractions of annuities. The next question we have to ask, of course, is, are annuities safe? Well, annuities are insurance products. So the first level of safety of an annuity is the financial strength and stability of the issuing insurance company. So ideally, you want to pick. So if you decide you're going to buy an annuity, you want to do a little research and pick the most stable and financially strong company you can that sells the product that you want. Furthermore, since annuities are insurance products, they, like all other insurance products, are regulated by the states here in the United States. To that end, each state has what's called a guarantee fund or guarantee association that is run by the state, and that fund collects taxes from companies that sell annuities to people within the state and then uses that money to guarantee annuities. The guarantees vary from state to state, but as of March 2018, the minimum guarantee was $300,000, which was the guarantee level in about 45 states. There are a couple of states that guarantee $350,000 and a couple more that will guarantee up to a $500,000 annuity. Now these dollar figures are the purchase price of the annuity. So annuities are generally safe. There have not been very many insurance company failures, and they are backstopped by state-run guarantee funds and associations. How do annuities work? Well, in principle, it's pretty simple. The first thing you want to do is select an insurance company that has good financial stability and sells the type of annuity you want to buy. Then you decide on the details of your specific annuity. Then you pay your payment to the insurance company. You buy the annuity. The payment is called a premium. Once that's done, you've bought an annuity, and the insurance company will pay you the agreed payment, either monthly, quarterly, semi-annually, or annually, for the term of the annuity. And the annuity term can vary from as little as 5 years to your life or your life plus the life of your spouse. At your death, the annuity ends unless you've selected a guarantee option of some sort. So that's the basics of how annuities work. Now let's look at some of the details. Now let's look at some of the terms that define types of annuities. The first type of annuity that you can buy is what's called a single life annuity. This annuity guarantees to make payments to you for your entire life. At the end of your life, when you die, the annuity ends. So this is a way to guarantee an income stream for your life. A joint life annuity makes payments for the life of the primary annuitant and then continues at either 100% of the payment or some lower value that's agreed upon when the annuity is set up, and that lower value is typically half or 2/3 of the initial payment, for the life of a second annuitant, at which time the annuity ends. There are also what are called fixed-term annuities. These annuities make payments for a fixed term of years, typically 5, 10, or 15 years, or longer. Another term that's important is what's called a guarantee term. A guarantee term is a fixed period of years during which the insurance company agrees to make the annuity payments, whether or not the annuitant is dead. In other words, if I buy an annuity with a 10-year guarantee term and I die in 5 years, the insurance company will continue to make the annuity payments to my heirs for the balance of the 10-year term. Typical guarantee term lengths are 10 and 20 years. Now that we've gone over the basic terms in an annuity contract, let's look at some of the additional options. One option that you can buy is what's called inflation protection. This varies by company, but typically involves some percentage increase in the annuity payment each year. Some insurance companies offer inflation protection that's tied to the consumer price index. Another term is death benefit. You can write an annuity contract that will pay a percentage of the initial premium at the death of the annuitant. There are also termination options. Most annuity contracts are locked in. In other words, once you buy the annuity, you can't get out of it. But you can buy a termination option. And this is an option to terminate the annuity with a return of your unused premium. In other words, if you had bought an annuity for, say, $100,000, and after you had received $50,000 in payments, you decided to terminate the annuity, the insurance company would return to you the unused part of your premium, or $50,000. There are lots of other options available, but they vary with the issuing company, so I'm not really going to go into them. One thing I do want to say, any option that you buy is going to reduce the value of the payments that you receive relative to, say, just a single life annuity. And furthermore, you have to buy whatever options you're going to buy up front at the time of purchase of the annuity. You can't go back 5 years after you bought the annuity and say, oh, by the way, I'd like inflation protection. You've already signed the contract and they're not going to change it for you. Okay, I've been talking about payments that you would get from an annuity. I thought I'd give an example of just how much payments might be in March of 2018. I want to note that these payments change all the time as investment returns change. So these are just a snapshot right now. The payments that I'm showing here were generated by going to one of the insurance company websites. I'm not going to say which one because they're all pretty much the same. And simply using their calculator to give me estimates of current payouts for a $100,000 annuity for a person who was 65 years old and was receiving payments monthly. The payments vary a little bit with the frequency. The longer the time between payments, the higher they are, but it's only a few dollar difference. One thing is that you'll notice that the payments that a man will receive are a little bit higher, around $20, than the payments that a woman would receive. That is simply because women have a longer life expectancy than men, and these payments are based on life expectancy. So, what are we looking at? The highest payment you can get, about $525 a month, and it drops down to about $480 for a single life annuity for a man. And you'll notice that if we invoke a guarantee period, which gives you some protection to get your premium back, the payments drop as the guarantee period gets longer. And if you want the option of premium return, it's also down, about $50 from a straight single life annuity. Joint life annuities are still less. They run around $440 to $450 depending on the specific option that you get. So if we look at these on an annual basis, we're looking somewhere between about $5,400 and $6,300 a year. And as I said, these will change all the time depending on the investment climate at the time you buy the annuity. So you have to look at the numbers at the time you're ready to buy an annuity. But this is what you can expect now for a $100,000 premium. If you had a $200,000 premium, the numbers would be about double what this is. So unless you have a lot of money to put into an annuity, you're not going to generate payments that will provide you with enough money to live on. So this is a supplement to your basic income, and it is a guaranteed supplement if you buy a whole life annuity. What about taxes? This is always an important consideration for any retirement income. Well, federal taxes depend on where the money you used to buy the annuity came from. If you took it out of a tax-sheltered account like an IRA, a 401k, or a 403b, then the payments you receive from the annuity are fully taxable. If you use after-tax money to buy the annuity, say from your savings account or an inheritance, then the amount of the payments that's taxable is age dependent. Basically, what happens is the IRS assigns a life expectancy to you when you purchase an annuity. This is called the age factor. The premium you paid for the annuity, say $100,000, is divided by the age factor, and that is the non-taxable part of the annuity payments for that year. The age factor changes periodically as you get older, so every year you'll have a different non-taxable part of your annuity payments. Furthermore, the total of the non-taxable annuity payments is limited over your lifetime to the initial premium you paid for your annuity, say $100,000. Once you reach that limit, all of the annuity payments are fully taxable. What about state taxes? Well, what can I say? It varies by state. Every state is different. Well, now that we know a little bit more about annuities, what are the major pros and cons of annuities? On the pro side, 1, annuities provide a reliable, steady income. Annuities are also one of the only ways to guarantee that you won't outlive your money. And finally, annuities protect you from market fluctuations. These 3 things together provide you with certainty, which many people want when they're dealing with their financial affairs. What about cons? Well, first off, when you buy an annuity, you lose control of the capital because you spent it to buy the annuity, so it is effectively gone. You don't have access to that money if you should need it. Given current payouts that I showed you a couple slides ago, if your life expectancy is less than about 16 to 17 years, you won't get your initial premium back unless you have paid for a guarantee of some sort. And finally, annuities lock you into a fixed return rate so that you lose potential future capital gains should the financial situation improve dramatically. Okay, that pretty much sums up what I have to say about annuities. I hope you've learned a little bit about them. I can't advise you to buy an annuity or not buy an annuity. That's a decision you have to make yourself. But hopefully the little bit of information I've provided here will help you should you need to make a decision about buying an annuity. that wraps up what I wanted to say in this video. Thank you for watching. Give me a thumbs up if you enjoyed the video. And please subscribe to my channel so that you will get notification when my next video comes out. Thanks again for watching.